Hello and happy new year, Vetavia community. My name is Hammer. I am here with you today for your mortgage market update. It is January 3rd, 2024. Our guest today is Mr. Jerry Avila. Jerry, thanks for joining us, man. Please tell everybody a little bit about yourself.
So, mortgage loan originator out of Arizona, but I service California, Colorado, Texas. Pretty much been part of the community here since its start. One of the what you would call the OGs of the group, and have nothing but great things to see and just watch happen within this community. It's insane. We went from 1,300 members at one point to where we are now. It's insane. It's awesome to see. But just somebody here who just likes to be able to provide info and likes to be able to support you guys in whichever way I can.
Awesome. Well, thanks for joining us today. Remember, everybody, what we do here every Wednesday, we hold your mortgage market update. And this is your opportunity to ask questions, talk about mortgage rates, get anything that you'd like to get off your chest, find out if you're getting a good rate, all that kind of stuff. If you're here live, we would love to have you. Let us know. Go ahead and say hello, share a comment. If you're watching on the replay, of course, we know so many of you actually can't be here live, but do watch on the replay. Go ahead and put any questions that you have on this post. We'll be glad to answer them as well. So let's jump right in and let's talk about rates. We'll start off with letting y'all know, remember, this is not an offer to lend. When we talk about rates, we're talking about averages and generalities, and you are free to ask any questions you want here in the Vetavia community. And this is your place where we can help you to kind of shop your rate. You should always be checking around. So anyway, if you are getting a rate quote these days, generally, your VA mortgage rates are going to be a little bit better than what we call conventional conforming rates. Somebody that has not served, is not a veteran or active military, that cannot get a VA mortgage, they're going to get a loan that's secured through Fannie Mae or Freddie Mac. Those are what we call conventional loans. And those rates are generally in the high sixes to the mid sevens on average. You're going to find higher rates if you're getting a second home or an investment property. But if you're buying a primary residence or you're refinancing a primary residence, an owner-occupied home, generally, those conventional rates are ranging from the high sixes to the mid sevens. If you're getting a VA mortgage, you're going to find a better deal. They could be sometimes in the high fives right now, generally to the mid sixes. And it's going to depend on your unique situation and your credit score and just a few different variables. So, of course, you want to make sure that you're talking to multiple people and shopping that rate. But if you're getting a rate quote in the high fives to the mid sixes, that's at least in that realm of where you should be looking. Does that sound right to you, Jerry? Are you seeing rates that are generally in that same kind of range?
Right in that range. It just depends on the person's FICO, their particular loan amount, whether it's jumbo, high balance, conforming loan. Just really depends on a bunch of variables. But yeah, that's right around
that area. So if you're seeing tremendously better than that, doesn't pass the sniff test, get it checked out. If you're seeing much worse than that, find out why. So as far as where rates are going this year, 2024, well, I could tell you that all of the forecasters agree that rates will either get as low as 3% or go as high as 9% or be somewhere in between. That is the 100%. Everybody is there. And that just shows you, that's my sarcastic way of saying that nobody knows what rates will do. Remember, and I'm a rate forecaster. And, according to everything we had seen a year and a half ago, we were supposed to be knee deep in a recession right now, and rates would have dropped already, and they hadn't. But the good news is we really do feel strongly, I feel strongly, that the worst rates for this round, if you will, are behind us. So we've seen in 2023, we saw mortgage rates that had hit highs we hadn't seen in decades. I started as a mortgage originator, a loan officer back in 2000. And I remember mortgage rates that were in the sevens and eights back then. And it's been 20 years since we've seen those rates. And we did see 8% in October. So hopefully the worst is behind us, and I feel very strongly that it is. And the reason for that is because of which direction the Fed is going, the economy and housing. I'm sorry, the economy and the labor market, as well as inflation. So we'll talk more about that in a minute. But rates, are likely to hold steady for a while where we've seen them. They've come down from those highs in October, but it's unlikely that we're going to see rates continue to just go lower and lower and lower and lower. It doesn't work nearly that smoothly. Generally, what happens is we go in fits and starts, rates will drop, then they kind of go up a little bit, then maybe they go up a lot, then they come back down again. That's how mortgage rates work. So that's why it's so important that you're educated and that you join us each week so you know kind of what's going on and which direction things are going. But in the very near term, rates are likely to hold steady. They could creep up a little bit this week. We're seeing some pullback from improvements we saw to end 2023. And all eyes are on Friday's jobs data. So I'm going to put this away for a minute here and bring Jerry up. And Jerry, do you kind of follow some of the different economic data like the jobs data? And can you share with everybody, what you think where rates will go over the next week or two or 5?
So I do follow them, and the only thing I question, which is on the regular now, I question everything I see, just because we go through these moments where it's like, oh yeah, well, the expectation is we're going to hit this number, and if it's anything below this, we're going to see the market respond this way, and we're expecting to see improvements on the rates, and then all of a sudden, next thing you know, there's some report that the Fed then takes a look at and says, oh, we like this number a little bit more about this. And all of a sudden it throws everything askew. So generally speaking, I'm going to say, yes, I do think rates will continue to improve slightly, but they're not going to really move too much where we're at right now. Those job reports are really going to be crucial in regards to just which direction we move right away. Long term, I do still think, though, we are going to continue to see that scale move lower on the rate scale.
I absolutely agree. And in fact, let's take a minute and kind of just educate everybody who's watching. So the Fed does not actually set mortgage rates, but they do manipulate rates in the economy. And they do that by changing one particular rate that they have access to. And that's the Fed funds rate. And that's the one that everything else kind of goes off of. So if you've got car loans, if you've got student loans, if you've got credit cards, if you've got equity lines of credit, or what we call HELOCs, home equity lines of credit, all of these are affected and can be tracked to that Fed funds rate. Now, the Fed, during the pandemic, the Fed took rates all the way down to zero, this Fed funds rate. And the reason they did that was they were trying to stimulate the economy during the lockdowns when nobody was going out and spending money. And we won't spend a lot of time going too deep on that, but that's just kind of your where we're at. Well, once we got through the pandemic, through the lockdowns, and kind of back to normalcy over the last couple of years, the Fed has been raising interest rates, and they've raised that Fed funds rate up to 5.25%. Okay. And they've done that in, I think it was 11 rate hikes over about 18 months. They did that. It started in March of 22. That is when they started hiking rates, and they finally just stopped at the end of 2023. I think the October meeting was the first meeting that they actually paused and have not raised rates since. So the October meeting, the November meeting, the December meeting, they did not raise rates at the end of 2023. So right now the Fed funds rate is at 5.25%. And what markets are looking at is how likely is the Fed to actually drop this rate, and why would they do that? Well, the first thing that I want to just explain to everybody is why the Fed would drop rates. And basically, when they increase rates, that is to slow down the economy. And the reason they want to slow down the economy is they want to reduce spending because we had an evil that took place over the last couple of years called inflation. And inflation is a big, big problem. We want some inflation. Inflation is a sign of a healthy economy, but too much inflation becomes a problem. And the only way to stop the price of goods from going up is to slow the economy down. And you're basically messing with supply and demand, because if supply tremendously outweighs demand, then you get inflation because people are willing to pay more for goods because they need those goods. If supply and demand are in an inverse and you have too much demand, if you have too much supply and not enough demand, that is where you don't have inflation because people lower their prices to sell their goods, and that pushes the economy down. Actually doesn't push the economy down, pushes inflation down. price of goods goes down, right? So instead, when you've got too much demand and pent up supply, too much demand and not enough supply, that's what we've encountered after the pandemic when we had pent up demand. And then that leads to inflation. And what they really want to get to is kind of an equilibrium. And there's no such thing as a perfect equilibrium, but they want to get close to that equilibrium of supply and demand. And that's kind of what the Fed is trying to do. The Fed's mandate is to control inflation. They want to get inflation to around 2% annually. All right. And that's not 20, that's 2%. Let me clean that up a little bit. There we go. 2%. And then their other job is to maximize employment. They want to get as many people working and keep a steady labor market. So that's why when we talk about what everybody is looking at the jobs data that comes out this week, because if the Fed sees that employment is weakening, well, they're more likely to actually start lowering or dropping their rates, because they know that they've gone too far and that they've slowed the economy down too much, and everything has a bit of a lag to it when they go through this. So all of the actions that they took over 2023 are likely, they did it in 2023, but it takes a while for this to take an effect, and they know it's going to happen in 2024. So they don't want to wait until they see inflation drop all the way down. They don't want to wait until they see unemployment tick up too high, because that tends to happen very quickly. So what they're doing is they're trying to time it. So they're going to start dropping rates, and they want to get that Fed funds rate, which is right now at 5.25. They want to bring that down to a more normal, natural equilibrium, probably somewhere in the twos. In that 2 to 2.5% range is probably where it'll end up. But that might be in 2024. It might take until 2025. And that's what markets are currently betting on. So what we see is, when we monitor where things are at and we look at what markets believe the Fed is going to do, and all these different Fed meetings that are on this fancy chart, and where they think that Fed funds rate will be, well, that's what mortgage rates are reacting to. So that is a long-winded way for me to say to y'all that when the markets believe the Fed is going to have to cut rates in 2024, mortgage rates react early. That's why we've seen mortgage rates come down already. If we start to see sentiment amongst markets, amongst traders, that the Fed is going to have to either hold for longer or possibly even increase rates again sometime in 2024, which is right now totally off the table. But if that were to happen, we would see rates go up very quickly. So what we're looking for is the Fed ready to start dropping rates? Markets believe that that's going to happen in March. The Fed, all the Fed officials, they've been coming out saying, hey, it's very data dependent. Don't rush things. Markets are like, hey, Fed, you could try to tell us whatever you want, but we think that you're going to need to do this sooner rather than later. And we don't think you're going to do it in January. That's what this fancy chart here says. It says in January, there's a 90% probability amongst the markets that we're going to stay where we're at right now. But in March, that 90% goes the other way, and there's only about a 25% expectation that we're going to stay where we're at. And then there's about a 75% expectation that rates will get cut in March. So as we get closer, if it looks like rates are not going to get cut, well, then we're going to see mortgage rates creep up a little bit. If it looks like the economy is slowing down and the labor market is weakening, which would encourage the Fed to go ahead and cut rates as soon as March, well, then we're going to see signs and mortgage rates will actually improve a little bit from here. So that is a long-winded explanation to give everybody, just so that you guys have the human intelligence so you can see what's going on and why these things are changing, and get it from a source that's not trying to get clicks or clickbait or, is telling you where we're at. So what would you add to all that, Jerry? I did an awful lot of talking. Now it's your turn.
No. It's I mean, that's kind of the same thing that I've been kind of talking with my consumers that come through and are asking questions about, what the expectations are. And I mean, we are looking at improved rates down the line here. It's very likely. And if it does continue down that path, what does that mean for, again, we've had this conversation numerous times about it, you and I, but it's like, what's going to happen once rates do come down? That's going to create more competition, create more opportunity for others to jump into the market that aren't in it currently, and ultimately driving home values up and increasing the cost of that home that you're looking at now. And so a lot of that really comes into play now, where this is where just like the Fed is trying to kind of like manipulate the market a little bit in regards to how quickly it moves. you're also being given the proper guidance, the proper analysis, so that way you can make a determination on whether do I move now or do I move later. Because ultimately that's going to be that's solely on you. That's your decision as a consumer. It's like, what steps am I going to take? Am I going to go ahead and jump the gun now, or am I going to wait till down the road and then ultimately know that I'm probably paying the price?
Yeah. Jerry, talk a little bit more about that. Why would someone want to buy a home now and not wait until rates go a lot lower?
So ultimately, especially being here in the VA space, right? The thing is that you have the benefit of the VA IRRRL. Once you've purchased something, all you have to do is wait 210 days from the first payment due date. That takes care of any issue that you have with the higher rate that you're getting at right now, right? But the actual truth is that as rates come down, the more competition hits the market, the more you're going to pay for that house. So now you're paying more for a house, still getting a little bit higher of a rate, because as we know, or as we are kind of predicting here, we're supposed to see rates continue to come down. And as they continue to come down, at some point, you're going to take advantage of that rate drop. Now, is it guaranteed? No, it's not guaranteed. Nothing is guaranteed in life. But at the end of the day, you know that based off of the trajectory and what's been going on in the market, things are supposed to smooth out a little bit and come down. And so those are kind of like the conversations that I tend to have. And it's just like right now, maybe the perfect opportunity for you.
Right. What happens to home prices when rates drop?
When rates drop, home values go up. And so when that happens, obviously the seller wants to sell at its highest dollar point. And with more competition means that you're going to have somebody else probably give asking price or higher. And then if that happens, then you get into a bidding war. Again, we saw that in 2020, right? 2019, 2020, we saw a lot of that where there was a lot of competition for properties. People were submitting 20, 30 offers and still not getting something accepted and getting frustrated. That's exactly what we're talking about. Not running into a scenario like that where you don't have as much competition on the marketplace that is going to facilitate things for you.
So awesome. Well, and again, remember, if you have questions, if you're thinking about buying a home and you don't know if it's a good time or if you don't have a good situation, you can, of course, post questions in the Vetted VA Facebook group. And you can also look at the Vetted VA map at vettedva.com and look, or is vettedva.com or .org? Let's see, I'm going to pull it up. But that way you can see where you find somebody in your area that can help you to answer those questions for your unique situation. You could find a vetted professional that has the training and experience. So yeah, it is vettedva.com. So awesome. Anything, Jerry, that you would add before we wrap up for today?
No, it's just, if you're kind of on the fence and wondering whether or not it's time for you to make a move, get with somebody, talk to somebody, because at the end of the day, you're not going to know unless you get the ball rolling. So ultimately, just do your due diligence, find out where you stand, what are your possibilities, and with all honesty here, guys, it's like we're not here to push you to buy anything. We're just going to give you the numbers as what they stand, and then it's up to you to make a call. We're here to support you, not sell you, right? So that's the biggest thing is just know that whoever you talk to, shop it if you want to. We encourage it as much as anything else, because we know that ultimately it's about you and not about us. So do what you got to do in order to determine where it is that you stand, and hopefully it'll be in a position that surprises you. It'll be in a much more proactive approach moving forward.
Very good. So thank you again, Jerry, for joining us. Remember, everybody, I do this each and every week. You can join me at 12 p.m. Eastern, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. Feel free to ask any questions live. If you have any questions from today, put them in the post here. Put them in the thread on Facebook. You could tag Jerry. You could tag Helmer, myself, for getting those answered, or any other moderators will answer them for you as well. Jerry, thanks again for joining us, man, and I'll see you on a future one. I know I will. You've been on a couple times.
We'll see you, brother.